Traders, I just want to talk to you about a setup which we took earlier in January. This was the US dollar versus the Russian ruble. I'm going to show you how we traded it in addition to why we traded it. So without further ado, let's discuss the setup. Towards the end of January, on the 22nd, on the weekly time frame, we saw this bullish pin bar reversal, which coincided with this level of support here. As you can see here, the US dollar versus the Russian ruble has been oscillating sideways. So this was a simple by the bottom of the range, with the bullish pin bar reversal punctuating our signal to buy. For those of you who are familiar with pin bar reversals, the iconic tail of the pin bar reflects the fact that buyers were very quick to arrest the bulls and essentially send the market upwards, which is, of course, a bullish sign. But what is interesting, apart from the fact that we've got a level of support here, is the fact that if we drag the Fibonacci retracement, which you already have, down from the lows of the US dollar from the Russian ruble all the way back in 2012 to the spike which we witnessed towards the end of 2016, this represents a rejection of the 50% Fibonacci retracement, and that was also very significant for our buy. We also knew that if we placed our order and traded this as what is essentially a standard entry, by placing our entry above the high of the bullish pin bar reversal with our stop loss below the low, we knew full well that if it triggered us into the trade, then that would be quite a significant event, because as you can see with the weeks preceding this bullish pin bar reversal, we haven't had price punching the top or breaking the high of the previous 1, 2, 3, 4, 5, 6, 7 weeks. So if we were triggered into the trade, that would be quite something. Okay, so that is a confluence of reasons why we went into this long. So we placed our orders up, and then what happened was we had the close of the next week, which actually closed as a bullish pin bar reversal. But the fact is, it was a inside bar. Okay, it didn't take out the high. However, this is where we take exception to our rule. Typically, if it doesn't take out the high of our bullish pin bar reversal and we're not triggered into the trade, and the next bar, if we're looking to buy, is also a bullish pin bar reversal, then that is an additional bullish sign. True to form with many reversals, they take far longer to essentially cook than trend-based plays, so we're happy to afford it that extra period of time, in this case, the extra week. So we left our orders. I know a number of traders in our online traders community moved their entry a little bit further down and their stop loss a little bit further up, or essentially placed a new trade and deleted the old one because they figured they could get much better reward to risk with the entry above the inside bar, stop loss below the low. However, we just kept our orders as we did originally. So what happened next? Well, we got triggered into the trade after the second week of having our orders placed. And as you can see here, we made quite a sizable gain, well over a 1-to-1 in fact. So this prompted us to move our stop loss to break even. And what we did also in order to cash in on gain profits or floating profits was to scale out of half the position. Okay, as we had a close at the top end of a pretty big bar, we figured that if price, worst case scenario, the next week went down and essentially pinged out our stop loss, which had been moved to our entry, then the original setup would no longer be valid. Okay, I know that our target, like I mentioned, was towards the top of this range, or I mentioned to members at the time of taking this trade, was towards the top of the end of this range, and we're already halfway there, so we'll typically scale out at this point anyway, and we're able to scale out as we risked 2% originally. We're able to make just over 1% with this trade, moving our stop loss to break even. So if price did come back the next week, worst case scenario, then we would have essentially still made a 1%, having scaled out half the position and moved our stop loss to break even. Okay, so what did happen? Well, this happened. The next week, we well and truly had the market come back against us, and we were very glad that we employed diligent management techniques as well as cashing in half the position when we did. And that's the art of trading. Essentially, it's a balancing act when it comes to management, taking profits off the table and mitigating against risk. So that's how we traded the Russian ruble, or indeed the US dollar versus the Russian ruble. Happy trading, folks.